Come on, 2, 3.
Well, good morning. Welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN AM for Monday, March 7th, 2022. And our top story today, continued market volatility. But does this present a buying opportunity for investors? Joining me now to discuss this and a lot more, Sylvia Jablonski is the Chief Investment Officer for Defiance ETF. Sylvia, it's great to see you. Thanks so much for joining us on the program this morning.
Hi, good morning. Great to be here, and thanks for having me.
Yeah, it's great to talk to you again. And really, I think where I want to start, I want to go in a lot of different directions with you, but I want to get your thoughts initially about where we are in the market cycle. You're an ETF provider, you're the Chief Investment Officer. I have to believe that you have a perspective on where things are headed right now.
Yeah, I certainly do, and I think that this market is unique now in that we're coming out of what felt like a couple of lost years with the pandemic and COVID being the focus of sort of everything, investing included. And now it feels like we're perhaps sitting on the edge of another lost year because of geopolitics. But you can always sort of dissect that a little bit more and try to figure out sort of what to do and where the opportunities lie. So, my general thought on this is I was doing some research on this too. So Russia makes up about 3.11% of the global market, global economy. Ukraine is less than 0.5%. So, this is obviously a huge humanitarian issue. And I just want to mention that we'll sort of put that aside because we're talking about markets and investing today. But that's an astounding issue, right? But in terms of the market itself, I don't think that it's going to have necessarily a huge impact on the markets. I think that this is basically another topic that is adding uncertainty because of things like the Fed potentially tapering very quickly, too much too soon, or the unknown about how much and sort of when, the thought that inflation remains high, and the market just sort of didn't need another uncertainty bullet point there. So what I think, though, is that if we take all of this aside and once we're sort of, past this particular issue, I suspect that the economic data is going to shine. And, perhaps we have slightly slower growth because of things like inflation and the price of oil. But I think that overall, it comes back to the fact that companies have strong balance sheets, fundamentals look good, the consumer is spending, retail numbers look good. And I think that towards the end of the year, that sets us up for, a double-digit return from where we are now. So these are kind of the FOMO days. It was really hard to buy in the heat of the pandemic. I mean, things just looked terrible. We had no idea when the world would reopen, but you have to think that, this is going to end, right? All of these things have some sort of conclusion. And at that point, the market sort of resets and moves forward, and the volatility on the way up, and sort of the momentum on the way up is usually higher than it is on the way down during these events. So sideways volatility for now. In the short term, definitely have some headwinds here. But I think if you have cash on the side, it's a good time to dollar cost average in, take some opportunities and sort of, don't look at the portfolio every day and freak out as it gyrates a couple of percentage points. It's likely to be okay. If you're fully invested, then I would say, don't recognize losses if you don't have to. And I'm bullish on the rest of the year. I really am. I heard the CEO of Snowflake on an interview that he did said today that 25 bips is really the first water stop on a 26 mile marathon, which means nothing. And I thought that was a great way to put it. You've got 25 miles to go, and that 25 bips is unlikely to do a whole lot. And that aside, the market, I thought yesterday responded well to that too.
Yeah. And Sylvia, if you're Chairman Powell, and the Federal Reserve, given what is happening in the Ukraine, between Ukraine and Russia with the invasion, that's just another data point, and you have to kind of be in the middle, right? You're kind of in that that old torture device, the Iron Maiden, where you turn one way, you get grabbed, you turn another way, you get grabbed. I mean, it's got to be challenging for the Fed to kind of determine if they're going to do, how many rate hikes they're going to do, and at what percentage they're going to be. I mean, if you're an investor, how do you handle all that? And you are an investor, by the way, but how do you handle all that additional information and what the Fed could do and might do?
I think that it's very interesting because when I watch some of these interviews with the Fed and just sort of hear people talking about it, people seem to have very opposite opinions on whether or not he's doing a good job and whether he's late to the game and put us in this terrible situation, or whether he's sort of the savior of markets. I think that the Fed chair did a great job, right? I mean, we had a novel pandemic that shut down the world economy, and particularly the U.S. economy, and he really kept us out of that and kept sort of market strong. He kept money in the pockets of consumers. They were able to sort of live and move forward, and jobs came back because of a lot of what he did. And in terms of raising rates too soon, if I were in his position and just as an investor, I wouldn't have done it either. I mean, how do you sort of get to a point where you're just recovering from a pandemic and January hits, Omicron comes, and we're totally shut down again, right? And nobody really saw that coming out. We kind of thought it was over, right? I think prior to the winter. So I think he took in the data as he said he would. He was transparent. He was very much communicating with the market. And I think he's doing the right thing now too, right? We have this massive unknown and uncertainty. We see the market pulling back. If you get this issue where the consumer is affected by oil prices, they're affected by heating their house and driving their cars and things like that, and because of that they stop spending in the near term, I actually think that that's a bigger problem than if inflation stays higher for 2 or 3 months before it starts to kind of pull back after the Fed hike. And given that, we do have sort of proof now that supply issues are easing. So we're still just not going to get that clear inflation number. And I think as an investor, I'm pretty confident that, he seems to be making reasonable decisions and isn't looking to throw us into a recession and isn't looking to, sort of protect the market. But he's definitely not looking to crush equity trading either. So I don't think it's a big factor in my investment picks, to be honest.
Okay, well, that makes a lot of sense. And again, he's a human being. The people at the Fed are human beings. They have a lot of data to go through. They have their own lives. It's hard to just put people up on a pedestal and just say this person is going to be the savior, right? I mean, there's lots of things that go into this. Sylvia, I want to take a very quick break. When we come back, we'll talk about how index providers are handling sanctions, what that means for you as an investor. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score, a credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. We're talking this morning to Sylvia Jablonski. She's Chief Investment Officer for Defiance ETF. Sylvia, thanks so much for staying with us this morning.
Thanks, Jeff. Great to be here.
Yeah, I like throwing, asking you great questions and getting your perspective on the market. Sylvia, ETFs continue to garner a tremendous amount of inflows, even in spite of this market and the volatility. And I guess that is a testimony to the dollar cost averaging you were talking about in the first segment. Let's talk about the passively managed ETFs. So they're based on an index. It could be the Russell 2000. It could be the 500. It could be some other index. Given the sanctions, given what's going on with Russia and the Ukraine, that horrific event, and the impact to companies and where they're invested, how should investors be thinking about some of these indices?
Great question. So, what these indices do is actually, in my mind, really make life a lot easier for the investor, because ETF companies and mutual fund companies essentially who create passive products essentially track these underlying indices and create this situation where you have very clear rules-based historical data that the investor has access to. So what I think is great about an ETF is that, if you're not sort of a stock picker, but you believe that technology will do well, or you want exposure to the S&P 500 in your retirement account or otherwise because you think it's sort of beaten down because of geopolitics and things like that, you can go out and buy an ETF and know that it tracks the underlying index that represents those particular themes. So, for example, the S&P 500, I mean, you have a million of ETFs and mutual funds to choose from, whether it's, SPY, IVV, Schwab has, free versions of those types of products. Every platform does. And I think they're all equally good and whatnot. But for something like the S&P 500, the index provider is simply, managing the daily rebalance to that index, and the investor gets exposure to that index on a daily basis. So because there are so many, indices out there to track, and also products that track them, the consumer can sort of be wise and say, okay, which product has sort of the best level of liquidity, meaning shares outstanding and, volume, and which product is the cheapest. And for something like that, there's no reason to buy an actively managed fund or try to pick something expensive. And I would argue that, probably for products that are broad index based, ETFs are sort of better choices than mutual funds, just because they tend to be a little bit cheaper. So the index methodology is something that the issuer has to speak to. So, for example, we have a hydrogen product and a 5G product at our firm, right? So let's say that next month, I think that, Verizon is just absolutely going to crush it. Earnings are going to be stellar. And I want to buy more. And I want to put more of that stock in our fund. I can't do that, because that's not what the rules say. What the rules say is that, we're giving clients exposure to a specific market cap at a specific percentage of these companies that are involved in 5G. And what that usually does over time is it saves the investor from, for having concentration risk to one particular stock. So you can kind of, and this is not to, in any way pick on them, but ARC, for example, they do actively manage. Right now, they're getting hit a little bit harder than passive, because with passive funds, we can't sort of emotionally react to anything, right? We have to follow the index methodology that we set forth, and that's saving us in that we're not overweighting to one stock or another. over time, both products can do extremely well, and active management can do extremely well. But, in volatile markets and in terms of just like risk management, I really like the idea of using, passive products for investors, particularly if they're not, sort of stock pickers and looking to have exposure to specific things, but rather themes.
Yeah. Let me ask you this, Sylvia. Last time that we chatted, we talked about, for example, if you were heavily into ESG or sustainability, there might be an index, or I know there is an index for that. Do you think that what's going on in the market today, what's going on with Ukraine, and I guess to preface this question, I'm sorry, I should have set it up a little bit better. We had someone on from Gallup last week talking about, hey, look, investors, this is based on a poll in November, December timeframe, that, hey, people like sustainable investing. People want to be able to take care of the environment, have social causes that they care about. Do you think that what's going on in the Ukraine, what's going on with sanctions, inflation, things that we're facing as individual consumers is altering that thought process, and maybe adjusting, that will adjust over time in terms of people saying, okay, I'm all for this, but in the short run, I need to be focused on this?
That's a super interesting question. And it's interesting because I've had so many debates about this particular topic over the last 24 hours with clients and other traders. So there's a group of people who sort of believe that because of what's going on in the Ukraine, we've done ourselves a massive disservice in America by trying to cut back on things like, fracking, drilling, and that we don't have a big enough oil supply to sort of not have any worry at all about what's going on in Russia, and, no sort of need for Russia. On the other side, I've heard a lot of people argue that this is great because what it's going to do is make people realize that we all need to be driving electric cars. We need to be powering our homes with solar energy. And so the clients with that view are now pouring into ETFs like the solar ETFs, the hydrogen fuel cell ETFs, the electric vehicle types of ETFs and stocks, right? Because they think that this is really a wake up call for, we have to do this differently. And if now, like, what will it take to sort of prove this? And on the other side, you have, investors pouring into OIH and Exxon and Chevron and Marathon Oil and just really trying to invest in those types of companies off of the idea that there's going to be a premium on those types of products and ETFs. So, I think that overall, to answer your question, I think that the world is going to a place where we care about climate change. We're making commitments, whether it's, in the US or globally, to be, make an attempt to get to carbon neutral. And so there are stocks that will benefit from that. And most of them are stocks that are related to things like hydrogen, solar, all sorts of clean metal types of plays, basically. So I think that the ETFs in those space are really interesting to look at now. And they are actually super cheap just because we're not there. We haven't done anything, and people tend not to look sort of 10 years out, right? But events like this, I think, bring that argument to the forefront and make those products interesting to at least consider.
Yeah, absolutely. And look, I mean, if you're an investor for, say, retirement, you're that long-term investor. You have to think about things right in the long. We're not talking about arbitraging and options and things like that in the short run, or maybe you go in and buy defense spending or defense stocks, right? Because of obviously because of how others are supporting the Ukrainians and how we're supporting the Ukrainians. It's a really interesting topic. Sylvia, I want to thank you so much for joining us this morning. We look forward to having you back on the program again.
Thank you so much. Thanks so much for having me, and have a great day.
That wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the latest curated news in lifestyle, wellness, finance, tech, so much more, and all in one place, check out today's edition of our daily newsletter, The Morning Pulse. And by the way, it's free. Want to see our latest content? Search our archives. We'll check out our website and also our streaming partners like Amazon, Roku, Samsung, and over 100 more. We're back again tomorrow for another edition of BRN AM. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Waiting here for you to take and drink of. But if you're tired, come on.
Now is your opportunity to co-create content around any topic on the First Lifestyle and Wellness Network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.